let's talk about a couple of broader market stocks. Let's start with Angel One, which is surging trade. This is on the back of a good set of numbers. Surbhi is here with us to decode the numbers for us.
Thanks for that. So Angel One is in focus. That is because of its strong Q4 numbers. Now the Q4 numbers were pretty strong given the volatility in the capital markets. The revenues were up 10% at 826 crores. Their EBITDA was up 20%, and this was largely because of lower employee expenses. Employee expenses were lower by 33% sequentially. The margins came in at 45% versus 41%, and the PAT was up 17%. The average revenue per client, that was also up 3% sequentially at 427 rupees. Looking at some operational data that came in, the total client base was up 10%. The gross client acquisition for Q4 was up 31%. The number of orders, that was up 16% at 26.3 crore orders. And the average daily turnover, that was up 28% at 1.85 lakh crores.
Okay, thanks a lot for that. But the other stock which is a big mover today, in case you missed out on it, is Just Dial. A good set of numbers is what the company reported. Healthy growth in revenues both sequentially and year on year. Reema is here with more details. Reema, over to you.
Thanks so much for that. So numbers are looking good. Revenues have gone up 5% on a quarter-on-quarter basis, nearly up 40% on a year-on-year basis, and things are finally getting back to normal. Now, Just Dial caters to the SME segment, and they were hit hard post-COVID. So now, finally, after 2 years, numbers are getting back to what they were pre-COVID. So this quarter's quarterly revenue at 232 crore is very close to Q4 of FY20, revenues of 234 crore. So as I said, things are now finally getting back to pre-COVID levels. Margins too have improved on a quarter-on-quarter basis at 14.4%. These are the highest levels in the last 2 years. Cash in the books is strong at 4,067 crore, and the company said that they will use the cash in the books either for their organic growth, or they could look at an inorganic growth as well, considering that adjacency acquisitions are now at far more reasonable valuations. The only little bit of a slip perhaps is the paid campaign growth at 16,340 crore. It's lower than the recent run rate, but then the company said that this is natural. These are quarterly fluctuations, and therefore they would not read too much into it. Listen in to what the management had to say about the growth, margins, and the outlook going forward.
As we move forward into fiscal 24 and as our revenue converges with our collections for this year, this margin should sequentially keep on seeing an uptick, which is visible in last 2 to 3 quarters as well. So on a long-term basis, I think this business requires 6 to 7% of our top line to be spent on advertising. It could fluctuate a bit on a specific year basis. For coming year, I think anywhere around 35-40 crores definitely we would want to spend, and further increases could depend on how things are panning out. B2B segment revenues were about 26% of our overall revenues last year, and overall in last 2 to 3 years this particular segment has obviously outgrown the B2C side of revenues, and we expect such outperformance to keep continuing in coming years as well.
Okay, well, Just Dial is up and buzzing, but on the opposite end of the spectrum is Quick Heal. That stock is down around 7.5%, trending closer towards its 52-week low, which stands at around 127 rupees, and currently the stock is at around 136.8. Reema's still with us to decode those numbers for us. Reema.
Thanks so much for that. So Quick Heal is a security solutions provider, and they've been hit hard this quarter because companies have lowered their technology spend since H2 of FY22. That's the reason why quarterly revenues are down 26% and year-on-year revenues are down more than 50%. Remember, Q4 is a typically strong quarter, but this time it's not happened. Revenues, as I said, are down 50% on a year-on-year basis because the companies have brought down their spend. In fact, the company says there's a sudden decrease in IT spending since H2 of FY22, and they foresee the same trend going forward. Now, because of the sharp drop-off in revenue, the company has also reported losses at the operational and the bottom line level. EBITDA loss stands at about 16-17 crore, while the bottom line loss is at 6.6 crore. Back to you.
All right, thanks a lot for that. So that's on Quick Heal and the reason why the stock is under pressure. TV18 is also under pressure post its numbers. In fact, both TV18 and Network 18 reported numbers. Surbhi is here to tell us why we are seeing, such a poor performance. Will be over to you.
Thanks for that. So TV18 is reacting to its numbers. Now, it's a pretty weak set of numbers. The revenue was down 6%. The EBITDA was down 70% on a year-on-year basis at 77 crores. Margins have come in at 6% versus 17% same time last year. And profits are down 75% at 35 crores. But if you delve deeper into the numbers, the news segment has done pretty decent. The news revenue was up 4% on a year-on-year basis. And the news EBITDA is down only about 12% on a year-on-year basis. The TV news EBITDA on a sequential basis has shown some improvement, and weak ad environment that has impacted the overall profitability. It's the entertainment segment which has dragged down the EBITDA. The entertainment revenue was down 9% at 1,045 crores, but the entertainment EBITDA, that was down 93% at 12 crores versus 180 crores same time last year. Now, the company is continuing to scale up its digital and sports vertical, and because of the investments in these verticals, it is facing EBITDA losses. Key triggers that could work for the stock going forward is the strategic partnership with Reliance, Bodhi and Paramount, which was announced over the weekend. So now they have 15,000 odd crores in their kitty to expand this digital segment. So that could be a key trigger for the stock going forward.
Okay, all right, Surbhi. Thanks very much for that. But let's move over.